Hi, good evening, and welcome to our webinar this evening, which is on the topic of inheritance planning. Just as the title suggests, we're going to be considering the planning you might want to do here and now, and we'll also be thinking about much longer term inheritance planning for when you've passed away. This is a delicate topic, and I'm mindful that we've been living through a year where death and illness have been part of the national conversation. It's also forced us, or perhaps given us the opportunity, to take a couple of steps back and think about how we're living our lives, the choices we're making, and what we might want to do differently. What we're talking about today, inheritance planning, is an extension of that. We will be thinking about how you can help your family and others you care about by giving them money now so that you can enjoy seeing the results. And we'll also be exploring how you can protect your wealth from inheritance tax so that you can leave as much as possible to those you care about when you pass away. So as a brief introduction, my name's Rebecca Aldridge and I'm the founder of Balanced Wealth Planning. I'm a chartered financial planner, which in short means I know quite a bit of stuff about all things financial. Most importantly, I have a holistic planning approach, always taking the stance that money is valuable not in its own right, but because it provides us with security, experiences, and the ability to support the people around us that we love. Money is important, but at the end of the day, it's a resource which enables us to have the most comfortable, rich, and interesting lives that we'd like. Something we've all been acutely aware of over the last year. So there's the formalities out of the way. Let's get started. The aim of this webinar is to provide guidance about a topic that's very often misunderstood, so that you can feel a bit more confident about your options and how inheritance planning fits into the rest of your financial plan. We're going to be covering what inheritance tax is, how to work it out if it's going to apply to you, and how much it could be. We'll look at giving money away, why you might want to do that, and what limits and rules can apply. We'll look at insuring against inheritance tax. And we'll also look at wills and the probate process. What happens when someone dies, whether they have a will or not, what you might put in your will, and what the process is like after somebody's death. You won't just be hearing from me. You'll hear snippets from an interview with another of our financial planners, Krupesh Kotecha, and Marie Cooper, who is a managing associate solicitor at Freeths in Nottingham. Marie's been a qualified solicitor since 2012 and has 14 years of experience working within legal practice, and Krupesh has been working in financial services for almost 20 years, so they know their stuff. Financial planning for inheritance tax goes hand in hand with legal services, and so it's important to consider the two areas holistically rather than as two separate parts. Now, on your screen, you'll see an area where you can ask questions. Please do ask any questions throughout the session and I'll answer them at the end. So let's start with inheritance planning and what it is. Inheritance planning is the act of deliberately thinking about who you want to pass your wealth on to, whether that be by making gifts during your lifetime or on your death through your will. It's often mentioned in the same breath as inheritance tax. And one of your motivations for thinking about any sort of planning might be to reduce inheritance tax. But there can be other motivations too, including giving away money so that you can see it being enjoyed and used, or keeping money in the family so it passes down the generations. That's particularly the case with things like agricultural land or family business assets. It's important to give some thought as to what your motivations are, because the planning steps you take should stem from there. So one of the key motivators is often a desire to minimize or avoid inheritance tax so that your family receives as much as possible from the wealth you've worked hard to grow. So let's start with that. What is inheritance tax? Well, simply put, it's a tax on the wealth of somebody who's died. It's worked out based on the value of a person's estate. And we use the word estate to mean a person's property, money, and possessions. Most importantly, and I'll mention this several times, money in your pension fund is not usually included in your estate. The tax liability can be quite significant at 40% of the estate. The good news is that many people actually don't have inheritance tax charged on their estate when they die because there are a few generous allowances. But there are plenty of people who will be caught. Maybe you are one of them. So now is a time to work out whether this is going to be an issue for you or not. So let's take a look at what we can shield from inheritance tax just by using the basic rules and allowances. Firstly, there is no tax to pay if you are leaving your money to your husband, wife, or civil partner. However, if you have a large estate, you may just be passing the headache on to them because it could be charged when they die instead. It obviously also means that unmarried couples do not have that option available. Next, there are two generous allowances. The first is the nil rate band, which is £325,000. And it means that that sum can be left to whoever you like on your death and escape inheritance tax. The second allowance is the residence nil rate band, and it applies if you own your own home, if it's worth more than the band value of £175,000, and on your death, you're going to be leaving it to your children or grandchildren. It also can apply, and you can use this allowance if you've owned your own home recently, but then sold it and maybe gone into a care home instead, for example. So if you have no children, or you won't be leaving anything to your children, you can't use this allowance. Both allowances that I've mentioned, the nil rate band and the residence nil rate band, can be passed between married partners or those in a civil partnership if they weren't used when the first person died. So if a spouse dies and they pass everything that they own to their husband, wife, civil partner, then the civil partner or spouse that has survived will also inherit the unused allowance. To be clear, that doesn't happen if you're going to be passing on your wealth to a partner you are not married to. They will not inherit your allowances. This means that anyone owning their own home and leaving it either to their married partner or their children will often have a total allowance of £500,000 that they can pass on tax-free. If they have a married or civil partner, the two allowances together come to £1 million. So you can see why a lot of people don't have to pay inheritance tax because their affairs will, excluding their pensions, come to less than £1 million. The rate of inheritance tax is 40%, and it's charged on the part of your estate above that threshold after you've taken the allowances off. It can be reduced to a rate of 36% if you're planning to leave 10% or more of your value of your estate to charity in your will. Remember again that money held in your pension is not included, and it's therefore considered outside of your estate for inheritance tax planning purposes. This is one of the reasons why it's important to start planning early, as pensions can be used to great effect to pass on wealth without incurring an inheritance tax liability. However, if the total value of your estate is more than 2 million, there are some issues. And we've only just got started with this, and there's a bit of detail here, which is a bit complicated. So if you have an estate of more than £2 million, the residence nil rate band is reduced, making more of your estate subject to inheritance tax. It can be quite complicated. These are just the basics. The residence nil rate band is tapered to 0 if the estate of a single person is worth more than £2,350,000. For somebody who has inherited their partner's residence nil rate band after their death, I'm afraid that both bands will disappear if your estate is worth more than 2.7 million. That basically means that if you've got more than £2 million worth of wealth, you are probably in the firing line to pay more inheritance tax than somebody who has less than £2 million of wealth. You can see it is not straightforward. I want to give you an idea about how this works in principle, and I've got 2 examples on this slide, 2 on the following slide. These 2 are focused on married couples, and what I want to do is to show you how substantial the tax can be in a couple of different scenarios. I have simplified this right down, and there are loads of nuances to consider, so this is just a starting point, and I always recommend you seek advice for your own situation. So in this instance, if we have a single person with children and an estate of £1 million, if they plan to leave their wealth to their children on death, they will be able to use their nil rate band and their residence nil rate band of £500,000 in total. That means inheritance tax is charged on the remainder, £500,000, 40%, that's £200,000 of tax. Oh, my apologies, I'm reading from a different slide. We'll come to that example in a second. The married couple with children on this slide. The estate value in this case is £1 million, including their home. They leave everything to each other in the first instance and then to their children. In that case, they can use both allowances. There's no inheritance tax to pay. In the second example, a married couple with children. In this case, they have an estate value of £2.7 million, including their home. They leave everything to each other in the first instance and then to their children. They've lost their residence nil rate band, that's gone to nil, so they just have 2 lots of nil rate bands to play with, £650,000, that's it. That's all that's protected of their wealth. Inheritance tax is charged on the remainder, 40% of just over £2 million. That's £820,000 worth of tax to pay on that estate. It's a really substantial amount. If I take you to this next set of examples, I've already read out the first example, so I won't do that again, but I will emphasize that unmarried couples are more vulnerable when it comes to inheritance tax. And these examples illustrate that a bit more, because in a couple, there could easily be tax to pay on the first death, and that money has to be found from somewhere, compared to a married couple where the allowance is transferred and the tax is paid on the second death, by which time their investments or family home could be sold to pay the bill. The second example that I hadn't looked at here was a single or unmarried person with children. In this case, they have an estate value of £2.7 million, including their home, and they plan to leave everything to their children. They have lost their residence nil rate band. They just have 1 nil rate band of their own of £325,000. In that case, they stand to have tax deducted of £950,000 from their estate. You can see why this is a topic that demands attention. If you want your estate to suffer less inheritance tax when you go, there are a few options, and here is a handful of the most common. So you can make your wealth less by spending it. You could reduce your wealth by giving it away or putting it into a trust. You can put your wealth somewhere where exemptions apply, like in your pension and certain types of investment. You could also increase your allowances by getting married or having a civil partnership. We're going to be exploring some of these as we go. So, of course, the most fun way to reduce your wealth is to spend it on experiences, trips, making memories. If you have dreams of big adventures and you're also wanting to reduce the inheritance tax when you go, well, now's the time to look at your budgets and start making plans. We use lifetime wealth forecasts to establish what level of spending is sustainable for you. and we make sure that you've got the money available to pay for those big luxury experiences. Our aim is always to make sure that you can afford to pay for it all. And of course, the context of this webinar is that you might want to deliberately run down some of your wealth and enjoy it, because it's better spent that way rather than being lost in taxes. I will add, however, that very many people have told me that they intend to actively enjoy and spend their wealth. And if there's a fair amount of it, it's actually harder than it looks. So let's move on to giving money away. And I know the word giving can sometimes cause a bit of a shock. Financial professionals and lawyers bandy the word about all of the time, but I know the idea of giving away money that you have been building and protecting for several decades and then losing control of it, it doesn't come naturally. That's why I usually suggest discussing making gifts and testing out how you feel and what you can afford over several months or even years. There's not usually a rush to make gifts unless you're in very poor health. There's just a growing acceptance of the idea, gradually continuing to test it out until you feel ready to move forward with it. The first thing to be clear about is that anyone can make a gift to another person of any amount at any time. If it's a cash gift, less than £325,000, which is that nil rate band, and if you haven't made other gifts in the last 7 years, there is no tax for you or anyone else to pay. If your gift is more than the nil rate band, £325,000, there will only be tax to pay if you die within 7 years, or if you're making that gift into a trust. The tax rate, if you're paying that money into a trust, is 20%. The primary consideration, I think, is why you want to make a gift in the first place. It may be to meet the cost of school fees, for example, pay off student debt for children or grandchildren, help them get on the property ladder, perhaps. The prime motive is often to reduce the value of your estate for inheritance tax for your children's benefit when you die, but it doesn't have to be. Plenty of people with no inheritance tax issues still want to make gifts because they know that they're not going to need all of the wealth they've got. My advice would be to consider if the recipient of this gift that you're thinking about needs or wants it. Speak to them. If this is to help them buy a house, for example, what do they actually need? Do they need more or less than you're currently proposing? Are they old enough and responsible enough to be sensible with this gift that they'll receive? If you're giving away an asset, will there be capital gains tax when it's gifted, potentially? And lastly, what impact will making that gift have on you financially? Can you afford it? I've spoken to many people with rental properties who have in mind that they will give them to their children. And you know, sometimes those children don't want the hassle of a rental property, or the rental income is going to cause them a real tax headache. And sometimes the current owner of the property realizes they actually need the rental income to live on. And particularly with a rental property, they might find that there's a large capital gain in its value, and giving it away, which will be treated like a sale, will mean paying capital gains tax. Giving that property away in those sort of circumstances doesn't really tick any boxes. So go back to your motivation and what it is you're trying to achieve. The reason for gifting can have a huge bearing on what happens to the asset or the money you've given away. The age and the tax position of the beneficiary of that gift and the date that funds are needed will all help determine the right choices to make. So here's just a few of the most commonly considered options, and it really is just a taster. So you can make cash gifts. You can make an outright gift of cash to a child or grandchild. It's the simplest way of giving money away. It's really effective where the money is needed for an immediate purpose, paying bills, paying off debt, for example, as compared with buying a house in a few years' time. The age of the child needs to be considered. Are they old enough to hold this money or perhaps investments in their own name? And do they have the financial maturity to use it for the purpose it was intended for? If they don't, what sort of controls are you going to put in place to make sure that it's used in the way that you'd like? If the answer to that question is no, that they're not ready, then it might be that the gift isn't made until your family member actually needs that money for a particular purpose, like paying for university costs, for example. Now, that doesn't help your inheritance tax position because we're talking about giving money away, but of course that might not actually be your motivation anyway. Moving on to junior ISAs, parents and grandparents can make investments into a junior ISA held in a child's name if they're under 18. The annual subscription limit is currently £9,000, and it's an allowance that means that parents and grandparents can save a pot of money which is free from income tax and capital gains tax. It can be accumulated and the child can then access that money at 18. It's quite a popular choice. I also want to mention lifetime ISAs. These are appropriate for 18 to 40-year-olds, and you can potentially suggest that money you gift to somebody of that age, they might want to save it towards a house, in which case they might want to put it into a lifetime ISA if they're eligible, because bonuses are paid on those contributions when the money is used to buy a first house. And pension contributions, don't rule them out. Contributions can be made into a child or grandchild's pension for them. Of course, the downside is that the child can't access that money until they reach pension age, which is 55 currently, but it will be 57 by the time they get there, or even a little bit older. Contributions into pensions are usually limited to £2,880 a year, but they attract tax relief of £720. So it goes up to £3,600 that goes into the pension after the relief is added. Higher contributions can sometimes be made, and it all depends on the child's tax position, not yours. Paying pension contributions is often disregarded as a planning tool, but it can free up their income to maybe be used on other things, for example. It's also a good way of making sure that your gift, your money, gets saved appropriately for the future and doesn't get blown on motorbikes and drink. As I said earlier, my advice is usually to speak to the person that you're planning on making a gift to and ask them what they'd actually prefer. There's also something practical to be aware of if you're thinking about making gifts to children who are under 18, and that's something called parental settlement rules. It's not very exciting, but I'll mention it here just in case it applies to you. Basically, if parents make gifts to their child aged under 18, and that gift makes income of more than £100 a year, that income is still treated as being the parents', and they will pay income tax on it. So you can't give money away to children hoping that the income is going to escape income tax in some way. That rule does not apply to grandparents, and also it doesn't apply to money being paid into a junior ISA, because ISAs don't pay tax on income anyway. So just something to be aware of. So I've just told you that gifts can be made of any amount, and we know that making a gift will reduce your estate, and so the inheritance tax bill will come down. But I'm sure you already know it's not that simple. You may well have come across the 7-year rule, which broadly means that if you die within 7 years of making a gift, some or all of that gift will be added back into your own estate as if the gift had never happened. So most gifts don't start to escape the reach of inheritance tax until at least 3 years have passed, and they don't completely escape inheritance tax until you've lived for 7 years. That's why if you're reading up on this at all, these types of gift, while they're in that 7-year space, are called potentially exempt transfers because they are not yet exempt from inheritance tax. Where there have been gifts within 7 years of death and tax becomes due, it's the recipient of the gift who's liable for that tax. But there are some exceptions where the 7-year rule does not apply. Let's take a look at them. Certain gifts can be immediately taken out of your estate or just not regarded as gifts at all. So firstly, payments by a parent towards their child's maintenance or education, they're not regarded as gifts and they're free from inheritance tax if they're under 18 or if they're in full-time education. That doesn't apply to gifts from grandparents, only from parents. Then there's an exemption which isn't really much known about, but it's often used by professional planners, and that's a rule about normal expenditure out of income. If you're making regular gifts out of your surplus income, and that doesn't affect your usual standard of living, those gifts are usually immediately exempt and treated as having left your estate. They will not be added back in when you die, even if that death is within the first 7 years. It's quite a powerful and underused exception. There's also an annual exemption. So up to £3,000 can be gifted to somebody every year, and this again will not be added back into your estate if you die. And if the previous year's allowance hasn't been used, you can carry that forward to make £6,000 in 1 year. So that's £3,000 per giver. You can also make small gifts. Any number of small gifts up to £250 can be gifted each year, provided they're to different people. And finally, gifts in consideration of marriage is another popular one. Each parent can gift up to £5,000 for consideration of marriage or a civil partnership, and that's immediately deemed to be outside of an estate. And for grandparents, it's a little less, £2,500. If you're in a relationship but not married or in a civil partnership, it's important to be aware that the rules are different to people who are married. Whereas married couples can transfer assets between each other in life and after death with no tax consequences, that is not the case with unmarried couples, where the normal gift rules apply, including the 7-year rule, where inheritance tax could apply if you die within 7 years of giving money from you to your partner. That's not a reason to get married, by the way, but it's definitely something to be aware of. So let's think about trusts for a moment. Gifts can also be made into trusts, and people with larger estates may well consider that, as well as the use of something called family investment companies as an alternative too, although we're not going to be covering them today. The appeal of a trust is usually because you give money away, so you reduce the inheritance tax on your estate, but you also keep an element of control over the money and how it can be used. That might be a desire to control because you want to make sure it's used in a particular way. Maybe it wants to be kept in the family, protected on divorce, or it might be because the recipients of this gift are young or vulnerable. I want to show you a video of my colleague Krupesh Kotecha talking to Marie Cooper, a lawyer at Freeths, who specialises in wills, trusts, and the legal aspects of inheritance planning. He asks her what can make trusts appealing and what types of trust are most commonly used.
Gifts up to an individual or couple's nil rate band are often made into trusts because trusts have some added features that can be quite appealing. So what type of trusts are commonly used, and when might somebody consider using one?
Trusts that are set up in lifetimes tend to be discretionary trusts, and that's where somebody decides that they want to get rid of an asset, they don't need it themselves, but they want to retain some control over it and who it's directed to. And so they set up a discretionary trust. They tend to also be a trustee, so they're in charge of who benefits from that asset and when. And then it's down to them to decide, along with any other trustees, who benefits from the asset and at what point. And there's usually a letter of wishes that's put into place as well, so that if anything happens to the trustee, then their thoughts in how they'd want the trust to be administered can continue. And so the trustees who do take over the running of the trust can fulfil those wishes. There are also bare trusts, and they're the most basic kind of trust, and the most straightforward one that there is. That's where you would give an asset to somebody and they would simply look after it for somebody else. It would be down to them to decide as and when who benefited from that. There are also trusts that can be put into wills, which is slightly different in terms of what they do, as they only come into effect on death. But as well as discretionary trusts appearing in wills, you also see a lot of lifetime trusts, life interest trusts, and that's where people want to, usually spouses, married couples, want to make sure that their property is protected for future generations, but also allowing their spouse to have a right to income from it, or a right to live in a property if it were a house, for example.
Okay, that sounds quite interesting. So I guess with the discretionary trust, there are some advantages in that there's some flexibility for beneficiaries, and it can be used for various different beneficiaries. And the bare trust is a little bit more straightforward in that the beneficiaries are named at the outset and who's going to get what. Would you say there are any disadvantages or any things to consider? I know there are some particular tax quirks between both types of trusts.
In terms of discretionary trust, depending on the value of the assets going in, there could be exit charges, and that's a charge when anything goes out of the trust. There could be entry charges depending on the value of the assets going into the trust, and 10 yearly charges. Again, those values would be dependent on the value of the assets going in and the value of the assets at the date of them exiting the trust, or the 10-year anniversary charges. But the charge itself is quite low. It's a maximum of 6% of the value of the asset at the time. The good thing about the trusts is that as soon as you give the asset away and it goes into the trust, the 7-year clock starts running. And if you survive 7 years from the date of making the gift, then that asset's out of your own estate for inheritance tax purposes, and so could lead to a substantial tax saving. Yeah. In terms of bare trust, again, the 7-year clock would start running as soon as you gave that asset away, but you wouldn't have the annual charges, the 10-year charges or the exit charges, but you then wouldn't have a lot of control. You'd lose that element.
Yeah, that's the downside, I guess, with that trust. So I think what we see is, in most cases, people that want to use trust tend to gift up to or as close to their nil rate band threshold, so that they don't have any of the sort of entry charges and so on, and potential charges along the way. Are there any planning opportunities for those that want to gift more than that? I know that there are some things like family investment companies that can be used.
Yes, family investment companies are a vehicle where they're also a form of trust, but they incorporate a lot of corporate elements. You tend to have a company that's set up to deal with the assets in the trust, and that company issues shares. And those shares are then held in different classes, and you'd have a different class of share passing to a different sort of beneficiary. So the owners of the company would have a different right to the assets in the trust, as opposed to the beneficiaries who might be children, grandchildren.
Okay. So I suppose one disadvantage of trusts or family investment company type solutions may be that professional costs may make the trusts sort of uneconomic, if you like. Would you say there's any sort of de facto minimum amount that people should be considering for use of trust to make it cost effective?
As you said, to make it cost effective, I'd suggest going as high as you can to the nil rate band, essentially, because then you're getting rid of as much money as possible without there being an immediate charge to tax. And then the costs of administering the trust are then sort of the value is a lot better.
Yeah.
In terms of professional costs as well, you don't have to have a professional trustee with the trusts at all. You could just have family members if you were confident in doing that. You would probably want somebody to assist with the tax calculation, so there would be maybe accountants' fees on top. But depending on what work was actually done, the cost of professional fees could be quite low.
Yeah, it doesn't have to be so uneconomic or so complex as people might think.
Right.
That's really good. Okay, well, thank you, Marie, for that valuable insight. It's been really helpful and useful. I'm going to look at now what somebody can do if they've done all their planning and there's nothing else that they can really do and there's still a liability. So what other options do they have?
Okay, that's really helpful. I'm hearing straight from Marie about how trusts work. So just recapping on some of these things, making gifts to a trust can allow you and as the trustee, one of the first trustees, to take responsibility for that money's management and to continue making all the decisions about it. You are likely to be a trustee during your lifetime. You don't have to be, but it's common, and somebody will take over from you when you die. The trust prevents the beneficiary, perhaps your child, for example, from being able to dip into that money that's intended for them. So for a child under 18, it's really essential, but using a trust can also be useful for young adults where there might be a concern about giving them too much too soon. It's particularly useful or even essential, actually, if a recipient of a gift is going to be vulnerable in some way, if they're mentally, physically impaired, or if it's a particularly large amount that could be overwhelming to them. There's loads of different reasons why you might use a trust. Marie mentioned bare trusts being the simplest form of trust, so there's a reminder about that here, and discretionary trusts, which are by far the most common and allow the greatest flexibility. You'll see much more information about discretionary trusts if you start looking into the subject, but all of the flexibility that you get with a discretionary trust comes at a price, and gifts, if they're under £325,000 into the trust, are fine. You're escaping inheritance tax. But if you gift more than that, then you can have a lifetime tax charge of 20% on the amount over your nil rate band. Trusts are not a panacea. There are downsides. Marie mentioned charges apply. They pay taxes in a way that perhaps you might not even do personally. And to be absolutely clear, when you've paid money into a trust, you cannot get the money back out again. Usually it's no longer yours. So I just want to emphasize, we're just covering the basics today about trusts and taxes and the relationship between them. It's really complicated, and the full detail is obviously well beyond the scope of this webinar. This is just about giving you a taster of what some of the things are that might form part of a plan for you. I'm going to just pick up on a question that's popped through and answer it at this point because it relates to trusts. So how are trusts seen by local authorities in respect of care home fees? Are they considered to be an active deprivation of assets and a way of avoiding fees? And the answer is yes, they can be. It depends on what the motivation is. If your motivation for putting that money into a trust is clearly for inheritance tax purposes, for managing your estate, for protecting somebody who's vulnerable, for keeping money in the family, for example, agricultural land I mentioned earlier, then your reason for putting that money there is clear. It's nothing to do with care home fees. That might be an unintended side effect of the situation. Although I have to say that the vast majority of people who are actively putting substantial amounts into trusts probably have so much wealth that they're going to have to pay care home fees anyway. Where you do have issues is where people put an awful lot or nearly all of their money, for example, into a trust or even their own home, and perhaps they're elderly. and perhaps they've started to have health issues. You can kind of see the story doesn't stack up. Perhaps these people don't even have inheritance tax problems, or there's no other reason why they would have put that money into a trust. So there has to be a story to explain what it is that you're doing. Another question was, can you combine several of the exemptions that we mentioned earlier, like marriage exemptions and regular gifts out of income? And the answer is yes, you can. Okay, so let's move on to exemptions. I said earlier that you could make use of exemptions and even get married to help reduce inheritance tax. And we're going to look at that now. So getting married or entering into a civil partnership shouldn't be done for tax reasons, but we've already seen from the examples at the start that life is a lot easier and the inheritance tax rules are a lot more forgiving if you are married. So assets can pass easily between you on life and death. I know several people who have got married from an administrative perspective, purely to just make life a little bit easier here. Sometimes their friends and family don't even know. So this isn't necessarily about having a big celebration for the sake of it. This is about what the rules are and how you can use them to your advantage. Also, I just want to remind you again that your pension does not form part of your estate. So putting money into your pension is a way of easily protecting it from inheritance tax. It's completely non-contentious to do that as part of your plan. There are also some reliefs available to reduce your inheritance tax bill, and this starts to go into the slightly more complex and maybe slightly more specific area. So the most common relief is called business property relief, and to a lesser extent there's something also called agricultural relief. These reliefs protect certain business assets that you own from inheritance tax on your death. And broadly, the idea is that the value of your own trading business and land or property that trading business uses should be protected wholly or partly from inheritance tax if you died while still owning it. So if you are a business owner and you're unlucky enough to pass away while still a business owner, there should be a little bit of extra protection. But of course, most business owners are planning to not be still running the business by the time they go. There are some specialist investment companies which provide specific investment portfolios which invest only in the shares of businesses that meet these requirements. And that means that your money invested in that portfolio would be protected from inheritance tax after it had been held for 2 years. You might see it advertised potentially, invest in this thing and your money will be protected from tax. But is it worth it? A portfolio of shares, a small number of shares in small unlisted businesses in the UK, it's extremely high risk in nature and it's not most people's cup of tea. There's a phrase that we use sometimes, which is don't let the tax tail wag the dog, which means that you shouldn't let the tax make the decisions here. Think more broadly about whether this is a good idea for you to do. And if there's a tax advantage, great, but don't do it the other way around. Finally, although it's strictly not an exemption or a relief, you can reduce your inheritance tax rate, as I mentioned earlier, to 36% instead of 40% if you leave 10% of your estate to a registered charity. So what if after all of this fantastic planning, there's still a liability that will be due? Or perhaps there's a period of time where there's going to be a liability when you have made a gift but it hasn't left your estate, or you intend to make a gift in 5 years' time, 10 years' time, but you've got a bridge between now and then where you would be liable for inheritance tax. One of the best ways to protect and ensure the full value of your estate can be passed on is to consider taking out life insurance. It's a simple and often cost-effective way of mitigating any inheritance tax charge that might be due. And it's a nice short-term fix. It perhaps buys you time until you can implement some of your more ambitious inheritance planning. It doesn't reduce the tax bill, but it generates a cash sum to pay the inheritance tax itself. Taking out a life insurance policy to pay some or all of your inheritance tax bill can make things a lot easier on your family when it comes to sorting out your estate after death. It can help to protect your assets from having to be sold to pay an inheritance tax bill, which must usually be paid before probate can be granted, and we'll be learning more about probate shortly. They're also pretty quick to pay out. This gives you the peace of mind knowing that your family and other beneficiaries don't have to rush around to sell the family home, for example, to raise the money needed to pay the tax bill when you pass away. And as I mentioned earlier, it can also just buy you time. You might be planning to make some large gifts in a few years' time that are going to eradicate your inheritance tax bill, but the time isn't right to do it yet. And you might want to do something to eliminate that tax bill in the interim period. Alternatively, you might have just made a big gift that will protect your estate from inheritance tax, but you've got to wait 7 years for the effect to be made, and you're exposed in the meantime. Depending on how long you might need this insurance for, you might be looking at a 7-year policy, or you might be looking at something much longer, or even the whole of your life, something which remains in force until you die. Insurance is typically used as a short-term tool because it can get really expensive later in life when your chances of passing away obviously increase. If you're in reasonable health now, it's usually not difficult or expensive to arrange this insurance. But if you have any health issues, the insurance can take time to arrange, and you can expect to have medical tests as part of the application. Something to be mindful of, particularly if you were inclined to try and do this yourself, is that most life insurance policies will count as part of your estate unless they're structured properly. So you could find yourself having passed away, your money falls into your estate ready to be assessed for inheritance tax, and there's also a life insurance payout which adds to the value of your estate and increases the amount of inheritance tax you have to pay. You normally need to have your policy, your insurance policy, written in trust, which can usually be done at no extra cost when it's taken out, and it's not difficult to do, but it needs to be done correctly. That makes sure that the payout does not go into your estate when you die, and it doesn't make the position worse. So in this final section, we're going to look at the probate process when somebody's died. I know it's not very cheerful, but it's something that I know everybody wants to know about and what's involved. We'll look at who pays the tax and how it's paid, and we'll look at the importance of drafting a will as part of your inheritance planning. So a will is your #1 tool in inheritance tax planning for when you die. It sets out what you want to happen to your wealth, who should get it, and if any conditions should apply. A will might also commonly include provision for a trust, as Marie mentioned earlier. That might be a trust that will receive money for your children while they're under a certain age, or it could be a trust to take care of some of your wealth for the benefit of a child or grandchild who's vulnerable. But it doesn't need to be. You can leave money in a trust through your will to anybody. Your will could also explicitly say which charities you want to leave a legacy to and who you want the guardians of your children to be if you are a parent of younger children. Another common scenario is where there are children from previous relationships. Perhaps this is a second marriage scenario. That will might need to have specific provision to make sure that the children of each relationship are always going to get protected when their parent dies. So what are the practicalities? When someone dies, it falls to loved ones to deal with their property, money, and possessions, known as their estate. It's hardly the first thing that they want to do at that time, but it's something they have to do. The legal administration of somebody's estate is called probate. This involves gathering together assets, paying debts, and distributing what is left to the beneficiaries. If the person who has died has written a will, This document will usually name the executor, the person who's going to be responsible for dealing with the estate. If that's you, then before you can start dealing with the deceased person's property and money, you need to establish your authority to act as the deceased's executor. And to do this, you need to apply for something called a grant of probate. If a will hasn't been left, that's called when somebody has died intestate. In that case, the next of kin will need to apply for a grant of letters of administration. Probate is required to access most assets following death, and it can take much longer than anticipated. Several months or even years is not uncommon. It starts with the registering of the death of the individual with all the relevant parties, and you then need to find out if there's a will and identify all that person's assets in the UK and overseas. You then need to submit a completed inheritance tax return and payment of the inheritance tax to Inland Revenue within 6 months. You have to pay off debts such as mortgage and other items like funeral costs and outstanding taxes. The grant of probate and permission to distribute the deceased person's assets to the beneficiaries can only be applied once the probate registry has evidence that the inheritance tax has been paid or that it isn't due at all. The assets can then be collected and distributed in accordance with the will, or in the absence of a will, intestacy rules will apply. It's easy to see how this task can be quite complicated, particularly if the estate is large, if there are doubts about the validity of the will, or if the estate includes foreign assets or property. Something that I always suggest is when you've got your will and you've kept it in a safe place, put notes alongside that, a piece of paper or two that spells out who your financial planner is, who your lawyer is. Information about the assets that you hold doesn't need to be in granular detail, but just to give somebody a starting point. You can well imagine that somebody's just lost their parent and they're having to go through drawers of information to try and find out some clues as to what that person might have owned. Make the job easy for that person that's going to be looking at things for you after you've gone. And that's even more the case where most of our assets now are held digitally. We can't look through drawers to try and find out if we have a certain policy or anything in place. So create a document, print something off next to your will that just gives that beneficiary a starting point. So to summarise all of that, we have another discussion between Krupesh Architecture at Balance Wealth Planning and Marie Cooper from Freeth.
It's clear that depending on the circumstances and various assets involved, it can be quite a complex task that can take a long time to sort out. And so my next question then is, who pays the tax and how is it paid? Because of course, the assets cannot be collected and distributed until that part's complete.
That's right. The inheritance tax has to be paid before the grant of probate can be obtained. And the executors, if there are executors named in a will, are responsible for that payment. If there isn't a will, then it's the personal representatives, so the people who are dealing with the estate there. Usually, the inheritance tax has to be paid in one go, so all of it has to be paid up front. However, if you have a property or properties and in some circumstances shares, the inheritance tax due on those assets can be paid in instalments, and so they're due at sort of 10% every year. The only issue with that is you get charged interest on top of that, and if the asset is sold prior to the 10 years where the final payment's due, then all of the inheritance tax has to be paid at that point. If you have an estate and there are lots of properties and limited amounts of cash, then you've got a slight problem because you might not have access to enough liquid assets in the estate itself before the grant is obtained to deal with those assets to pay the tax. And that's where there can be problems. Executors can, if they've got funds themselves, loan monies to the estate to pay the inheritance tax and then repay themselves when there is enough money in the estate to do that, or they can look to take a loan. They can be quite hard to obtain. So the hope is that people do some planning if they know that there's going to be an inheritance tax liability, just so that there's enough cash there to cover the initial charge.
Yeah, that makes sense. I guess there can be other issues as well then if there isn't enough cash. So if somebody's got a business, or if the money's tied up in some sort of investments that they can't liquidate easily, they might need to find it another way. If they have to pay the bill in one go, is there usually a time limit when they have to pay it?
Yes, the deadline for inheritance tax is 6 months at the end of the month from the date of death. If it's paid after that, it's okay, but interest is charged. If it's not paid within a year of death, then HMRC will impose the interest, but they'll also charge penalties as well. And those penalties will be dependent on the value of money in the estate and down to what has caused the delay. So the tax definitely has to be paid within a year, preferably before 6 months. Yeah,
so ideally fairly quickly as well then.
Yeah.
Okay, and so you mentioned personal representatives of a will. So can we talk a little bit more about the importance of drafting a will and maybe the implications of not having one?
Yes, quite simply, if you make a will, you're choosing the people to deal with your estate and who benefits from it. If you don't make a will, your estate is subject to the rules of intestacy, and that's where the law says who benefits from your estate. Everyone's situation is different, but if you are in a second relationship, maybe where you've got children from a previous relationship, you should definitely consider having a will to make sure that those children are looked after, if that's what you want. If you're a single person, you would want to think about making a will just to make sure that the people that you want to benefit from your estate do. A lot of the times, the rules of intestacy don't really correspond with what people want and what they want to happen. And so it's better to have a will in place, and especially in terms of tax planning and protecting assets from care fees or a surviving spouse having a future relationship. There are lots of different things that can now be done within wills, as well as the straightforward kind of just making sure that whoever you want to get something does.
Yeah, so it's a really good planning tool to use in advance of somebody passing away. In terms of, you mentioned if somebody doesn't have a will and the rules of intestacy apply, but let's say if they have a will but it isn't quite what the beneficiaries want or intended to happen, is there anything that can be done there?
Yes, you can have what's known as a deed of variation, and that's where the beneficiaries of a will decide that they want to change it, essentially. It has to be done within 2 years of death, and it has to be signed by the person or people who are going to be negatively affected by the change. So, for example, if a will left an asset to grandchildren and those grandchildren were named and then more grandchildren came along, provided that those grandchildren or other people were over 18 and could consent to the change, they could agree that the new grandchildren could benefit from the estate. So there is tax planning that can be done, and other forms of planning and changing the will after death.
That's fantastic. It's really informative hearing from Marie directly about that. So we're coming to the end of our session this evening, and I'm just going to remind you about some of the key things that we've covered. So you should by now have a much better understanding of what inheritance planning is about, and we've learned about inheritance tax, when it's payable and who pays it. We've also gone through how to reduce that inheritance tax liability by spending your wealth, giving it away, whether directly to people or into trusts. We've looked at some of the most common exemptions and reliefs that can help with planning, and we've touched on the idea of insuring against inheritance tax so it can be paid that way. And finally, we've had a reminder about why a will is important and what the probate process is like. If any of these issues apply to you, I'd suggest that you speak to your financial planner and ask to cover that in depth at your next financial planning review. Or if you don't have a financial planner yet, now's the time to get in touch with one. We just urge you not to leave this type of planning at the bottom of your to-do list, as our experience tells us that that can really limit the options available to you. It is a specialist subject, and it's one that needs a lot of care because the decisions you make are usually irreversible. Obviously, we can't cover everything within today's webinar. It's only 1 hour, and the best course of action is going to depend on very much individual circumstances. But there's a big opportunity here. Inheritance tax is sometimes called the voluntary tax. The Inland Revenue collected 5.2 billion in inheritance tax in the last tax year. Do you want to be one of those people? So the main takeaway is that you shouldn't worry too much about it. Seek advice if you think you have a tax liability or if you're not sure, and explore all of the planning opportunities available, giving yourself plenty of time to make the decisions. It's equally important to keep your inheritance planning strategy under regular review because circumstances can very dramatically change, just as we've seen during the last year. So you have some key contact details here, and of course you're very welcome to get in touch with us at any time, and you've got Marie's details on there as well. This is part of a regular series of webinars that we host. So we've previously covered subjects like financial planning, divorce, redundancy, selling a business, ethical investing, and retirement planning. All recordings for those are available online and on request. So if there's something that you can't find, let us know. If there's something you would like to know more about, also please let us know, and we'll consider putting that on part of the list of future webinars to record. So I just want to turn to one more question that I can see that's come through. So what are the rules about putting money into a pension in terms of timing or amount? E.g., could you move money from ISAs into a pension account? That's a really good question. And the answer is yes. You can take money out of an investment, whether it's an ISA or a general investment portfolio, and you can move that into a pension. But there are rules that apply there are rules that apply to how much you can pay into a pension in any year. And they are super complicated, but I'll give you some highlights. If you are not an income earner, so perhaps if you're retired or if you just don't earn any money, then the maximum that you can pay in is £2,880 a year, and that attracts tax relief of £720. If you are earning money from work, then you can usually pay in 100% of your earnings or £40,000 if that's lower, whichever is the lowest. If you have your own business, then your company can make a pension contribution for you, and that's usually £40,000 a year. That is really skimming the surface of those rules. So do go into that in a little bit more detail with your financial planner to see what's possible for you. But in answer to your question, the contribution does not need to come from cash. It can come from an investment that's been sold. I don't have any more questions here to answer. If there is anything else that you've got a burning question, please quickly get that in the Q&A box and I will answer that. In the meantime, I just hope that it's been really useful touring through some of these key points to consider if you're planning for the future. If you need any advice, please get in touch with any of the professionals mentioned in this webinar and any of the financial planners in my team, of course, as well. You'll receive a feedback form shortly, so we'd really love to hear whether you found this helpful, if there's bits that you wish were included and weren't, or something you heard too much of. We'd love to have some feedback. And you can also request a link to the webinar recording there as well. So if there are no more questions, and I can't see any more coming through, then I'm going to just wish you a very pleasant evening and hopefully speak to you soon.